on Understanding the Balance Sheet with me, John Bohm. Right, straight to our first LOS, describe the elements of the balance sheet. And here you are, we've got a classified balance sheet here where we've got current assets and long-lived assets, and as a result total assets on the left-hand side, and we've got liabilities split between current liabilities and long-term liabilities, and also owner's equity split between contributed capital and retained earnings on the right-hand side. And of course we will notice, due to the balance sheet equation, our total assets equal our liabilities plus equity, 420 million in both. So what we're going to have to do is really talk about each of these items in turn. So let's start off with our assets. Remember the basic definition of an asset: it's a probable flow of future economic benefit to the entity, and we should be able to measure it with some reliability, i.e. put a dollar value on it. So we've got a list here of the typical kind of assets we're likely to see. Cash and cash equivalents. Well, cash equivalents are just short-term marketable investments that can be converted into cash. Normally the definition is convertible within 90 days. And of course this includes money market instruments. Inventories, of course, these are inventories of raw materials, work in progress and finished goods. Trade and other receivables. Well, trade receivables are where you've sold goods, of course, at year end but not yet collected the cash. Other receivables are any other amounts that you're owed from third parties. A prepaid expense is when you've paid for a good or service but not yet used it at the year end. We then have our financial assets. These are debt and equity instruments that we hold, investments that we hold in other companies. You've got deferred tax assets as well. Now again, I don't want to worry about deferred tax assets now. We'll see, we've got a reading on deferred tax a little later on. We then turn our attention to our longer-lived assets. Notice we've got our property, plant and equipment. These are our tangible fixed assets that we'll use within the business. We've got investment property, which we'll see under IFRS but not US GAAP. This is property held for its rental receipts or alternatively capital appreciation. Intangible assets, so assets held for continuing use with no physical form. Equity accounted investments, again I'm not excited by this, we'll see it really at level 2. This is essentially where you have investments in associate companies. Associate companies are where you have influence over them but not control. Natural resources, so when we've gone out and bought oil fields or maybe forests, etc. And then finally a classification called assets held for sale. These are really any of our long-lived assets like PP and intangibles where we've decided to dispose of them. Once you decide to dispose, they come out of your assets held for use and get transferred into a classification assets held for sale. Our liabilities. Well, liabilities, of course, are probable sacrifices of future economic benefit, i.e. things that lead to cash outflows. So in other words, sacrifice of economic benefit as a result of past transactions. Now they could be amounts received but not reported as revenue in the income statement. This in particular is referring to deferred or unearned revenue. So if a customer pays you but you've not yet met the earnings criteria, you can't record it as a sale. So instead we record it as a liability. Once the earnings activity is complete, we'll release it from liabilities into income as a sales figure, as revenue. Also, we've got amounts reported as expenses but which have not yet been paid. In particular, we refer to these as accruals. So let's have a look at some of the items we might see. Bank borrowings, particularly loans. We might see notes payable. These are short-term interest-bearing forms of debt. Provisions, remember these are estimated future expenses. So as soon as we foresee an expense, we estimate it and put it through our income statement. The other side is it appears as a liability in our balance sheet. Unearned revenues, we've already described, when a customer pays you but you've not yet met the earnings criteria. Accounts payable, where you've bought goods from your suppliers but not yet paid them at the year end. We're going to see financial liabilities, in particular bonds that the company has issued, leases that the company has taken out. Accrued liabilities, where you've used a good or service but not yet been invoiced for it or paid it at the year end. And then also something called deferred tax liabilities that we'll discuss in greater depth in a later reading. Let's have a look at our equity. Well, of course, we've said a balance sheet, assets equals liabilities plus equity. So if we subtract liabilities, assets minus liabilities, otherwise known as net assets or occasionally net worth, equals our stockholders' equity. What characteristics does equity have? It's permanent. So in other words, you wouldn't include redeemable preferred stock within stockholders' equity. Typically, you treat it as debt. There are no mandatory charges against earnings. In other words, dividends are discretionary. The directors get to choose whether to pay them, and for the common stockholders, they get to choose the size as well. And then finally, of course, legal subordination to other creditors. So if the company was to be liquidated, your common stockholders are the last people to get a repayment. Now, we're also asked to describe the use and limitations of balance sheet analysis. In particular, balance sheets are going to allow us to assess the liquidity of the company. What is liquidity? It's the ability to pay off short-term liabilities as they fall due. Solvency, which really looks at debt to equity, and also the ability to make distributions, i.e. payments to the shareholders. Major limitations, well, our balance sheet is a bit of a mixed bag. Some of the assets are going to be sitting at historic cost, some of the assets are going to be sitting at amortized cost, and others are going to be reported at fair values. So we've got different measurement bases for assets and liabilities in our balance sheet. Now, of course, there's another problem. If you're using historic cost, of course, those costs could be severely out of date. They no longer reflect the economic value of the asset. Fair value might be a better measurement. But even a company that's using fair value, of course, may have a problem because the accounts are not published until after the year end. And as a result, fair values may have changed between the balance sheet date and the date where the users of the accounts are actually obtaining the information. One final problem as well is that the balance sheet doesn't include off-balance sheet assets and liabilities. Now, the classic off-balance sheet asset and liabilities are caused by operating leases, and we'll see those in a later reading. Our next learning outcome asks us to describe alternative forms of balance sheet. Now, you have a report format where you see a single column with assets, liabilities and equity all reported in a single column. What's probably a little more common than that is to see the account format where you see the assets on the left and the liabilities and equity on the right. And the balance sheet that we looked at a few slides ago, of course, was using the account format. Now, most balance sheets will be classified balance sheets, meaning we group accounts into subcategories. It could be current assets and liabilities versus non-current assets and liabilities. We may group financial investments together against non-financial. And some institutions use liquidity-based presentation, liquidity being the ease of conversion into cash. In particular, that's common with financial institutions. Okay, so we now need to compare and contrast current assets and non-current assets, as well as current liabilities and non-current liabilities, and we need to describe different types of assets, liabilities, and their measurement basis. So let's have a look at a definition of a current asset. So, current assets are cash and other assets that will be converted into cash or used up within 1 year or one operating cycle, whichever is greater. The cash operating cycle is the time taken between receiving raw materials and selling finished goods. Typically, it's more likely, therefore, to be within a year. That is more likely to be greater than the operating cycle. So a current asset is either cash or convertible into cash within a 1 year period. So notice the operating cycle, you can see the time taken to receive raw materials, produce the good, sell the good, and finally collect the cash from your customer. Now, current assets tend to be reported in the balance sheet in order of liquidity. Under US GAAP, you see the most liquid assets first, i.e. cash is the most liquid assets because it already is cash. And as you go down the list, you get less and less liquid until you end up with intangibles. Whereas under IFRS, you see the least liquid assets first. And as you go down the list, you get more and more liquid until you end up with cash itself. Okay, so current assets are going to reveal information about the operating activities and capacities of the firm, and we're going to see that massively reflected when we look at ratios a little later on. So let's have a look at some of our current assets, therefore. We've talked about cash and cash equivalents. Cash is cash itself. Cash equivalents tend to be money market instruments with maturities of less than 90 days. We argue they're almost as good as having cash. And typically these are going to either be held at amortized and discounts. That will make more sense to you, I promise, once you've looked at liabilities and you've seen how we account for bonds. Or potentially fair value if it's a listed security, i.e. its market value. Marketable securities are going to be held at either amortized cost if they're treated as held to maturity, or fair value if we classify them as available for sale or trading securities. Accounts receivable and trade receivables typically are going to be held at their net realizable value, i.e. we take the amounts owed by customers and we deduct the bad debt provision. Inventories, well, of course we have our raw materials, our work in progress and finished goods. What is work in progress? It's goods that we've started to construct at the balance sheet date but not yet completed. Now, if we're a manufacturing company rather than a simply trading company, a manufacturing company obviously constructs the goods that it sells, whereas a trading company just buys in goods and then sells them on. A manufacturing company, we typically use standard cost to establish the value of our finished goods, the standard cost of production. Companies essentially that are buying in goods and then selling them on typically will use some form of cost flow methodology, our FIFO, our LIFO and our average cost. Prepaid expenses are going to be reported at historic cost, whatever we paid for them. Remember, a prepaid expense is where you've paid for a good or service but not yet used it. And deferred tax assets are going to be the amount of the future reversal less a valuation allowance. Now again, I won't worry about that right now. We need to look at deferred tax in a later reading before that will make any sense to you. So let's have a little look at inventory, and we're going to see this here and then again in a later reading. Typically, inventory is held at the lower of cost and net realizable value. Now what is cost? We've already said it on the previous slide. It's the standard cost of bringing your inventory into its current location and condition. Once the inventory is complete, i.e. you've converted it into a finished good, any other costs, i.e. storage for example, are not included. So notice what we're going to exclude. Abnormal amounts. So maybe we've got abnormal material costs because of, I don't know, maybe there was a spike in our material costs, or abnormal labor costs due to industrial action, strikes, etc. Well, we ignore that. We include the standard costs of production. Storage costs for our finished goods, again, are not going to be included. It only includes all of the costs of getting your items into their finished status and location. Any additional storage costs are not included. Instead, they'll be included in our sales, general and admin. Administration overheads are not directly related to the production of goods, so cannot be included. As selling costs as well, remember it's only the cost of completing your finished goods. Any costs of making a sale are after the goods are complete, so they can't be included either. So we're going to look at the standard cost of production, and then we're going to compare that to net realizable value. Net realizable value, we take the estimated selling price. If we're looking at work in progress, we would also then need to deduct the estimated cost of completion. If we're looking at finished goods, of course, that line won't exist. Then deduct any selling costs to get our NRV. Now, essentially, as long as cost is lower than net realizable value, we'll record the inventory at cost in our balance sheet. If net realizable value, though, is to fall below cost, we have a write-down. We need to reduce the value of inventory to its net realizable value in the balance sheet. The other side of the entry, of course, appears as an unusual or infrequent item in the income statement. Notice IFRS uses cost compared to net realizable value. US GAAP uses cost compared to market value. Now, market value essentially is replacement costs subject to an upper and a lower level. The upper level is net realizable value and the lower level is net realizable value minus normal profit margin. Again, you don't need to worry about that. We will see it again in a later reading. Okay, so that is our inventory. Let's talk about our non-current assets. Now, our non-current assets, of course, are our plant, property and equipment, our intangibles, and also potentially investments held for long-term use in other companies. So investments in our associates, investments in our subsidiaries, investments in our joint ventures. Non-current asset, basic definition is it's an asset held for continuing use within the business, not resale. All this simply means is when we buy this asset, we intend to hold the asset to use to generate our revenues in the income statement. We don't intend to sell it. Doesn't mean we can't sell it, it just means the express intention. So these are going to be assets that are not consumed or disposed of in the current period, and as a result it's the infrastructure, it's the capital infrastructure from which your firm is operating. By looking at the non-current assets, we're going to get information on the firm's investing activities, the investments that it makes in debt and equity in other group companies, the investments that it makes in things like plant, property and equipment and intangibles. So here are our major classifications of our long-term assets. We've got our tangible assets that we often refer to as plant, property and equipment, such as land and buildings, equipment, natural resources as well. Intangible assets that have no physical form, being copyrights, patents, trademarks, franchises, and of course the most famous of all, goodwill. And investment property. Just be a little bit aware, investment property is only a classification under IFRS. It does not exist under US GAAP. These are essentially properties that we're holding, or if you essentially for their income, i.e. their rental potential or capital appreciation. Now notice with our plant, property and equipment, we're going to record them at purchase cost, including any costs of shipping them, installing them, or if we're manufacturing themselves, constructing them, including labour, materials, overheads and interest. So we can include in the cost of our assets all of the costs of getting the asset into its current location and working condition. So let's describe depreciation and depletion. Tangible assets are PP&E. Now, of course, we've already said they're going to generate revenues over a number of periods, and therefore we need to match their cost against those revenues. And the method we use is depreciation. All it's going to do is spread the cost of the asset through the income statement to match against revenues. Now, there is one asset that is not going to be depreciated, and that's land. Remember, what depreciation is doing is it's spreading the cost of an asset over its life through the income statement. Now, of course, the issue is with land, it has essentially almost an infinite life, or at least as long as the planet Earth, and as a result, spreading its cost over its infinite life gives you a zero depreciation amount. Natural resources are where we've gone out and bought things like oil fields or bought forests, etc. Now, of course, what we're going to do is we can consume these natural resources and convert them into inventory. And the method we use to record the consumption of these is depletion. Okay. Essentially, all it's going to do is allocate the cost per unit of natural resources as we use them and convert them into inventory. Now, balance sheet values, carrying values, or sometimes called book values, we're going to report them at historical cost, i.e. purchase price normally, minus accumulated depreciation. Now, accumulated depreciation is simply a running total of the amounts that have been charged through the income statement via depreciation to date. Okay. Now, of course, if you're talking about natural resource, then it's going to be historic cost minus accumulated depletion. And we said yes, unless the asset is impaired. An asset is impaired if essentially its fair value falls below its carrying value. And we're going to talk about impairments in some detail later on. So notice historical cost less accumulated depreciation for US GAAP and IFRS. Just be aware that IFRS also allows us to record our PP&E and our intangibles at fair value. In other words, we can mark them to market and take any unrealized gains and losses direct to our stockholders' equity. Again, we'll talk about revaluation in more detail a little later. So let's have a look at some intangible assets that we may spot. We talk about identifiable intangibles and unidentifiable intangibles. Identifiable intangibles, you can see, are linked to rights and privileges that have a finite benefit period. In other words, they have a finite life. And because they've got a finite life, we're going to amortize them over the finite life. And we said we normally amortize in most situations using straight line. Unidentifiable intangibles are assets that cannot be acquired singularly or have an indefinite, i.e. an infinite benefit period. Now, our classic one is goodwill, You can't go out and buy a company's goodwill as a separate asset. Instead, you acquire the goodwill by buying all of the company's balance sheet, its assets, its liabilities, etc. Essentially, goodwill is the difference between the price we pay to acquire a subsidiary and the fair market value of the net assets that we've acquired, i.e. the balance sheet net assets adjusted to fair market value. Now, instead, because it's not amortized, it's subject to an annual impairment review instead. And we're going to see impairment reviews again in a later reading. So let's talk about our intangibles. They can only be recognized if they can be measured reliably. What this tends to mean is most of the intangibles that we can recognize in our balance sheet are purchased intangibles. It generally excludes internally generated intangibles because it's very subjective regarding how much they are actually worth to the company. What is their value? Very difficult to put a dollar value on them. So, for example, purchased and patents and copyrights we can include. Purchased brand names and trademarks we could include. Internally generated brand names, well again, look, the problem is, what would be the dollar value? It's too difficult to attach a reliable dollar value, so you're not allowed to capitalize internally generated brand names, trademarks, patents, copyrights. Same with franchise and license cost. If you've purchased them, fine. If you've internally generated, no. Notice direct response advertising may be or can be capitalized. Direct response advertising is when it's essentially things like cold calling. Now, what the accounting standards say is if you can prove that this advertising has led to higher sales in the past and there's no fundamental change in your business environment, then these costs can be capitalized and then amortized against those higher future revenues. Goodwill, and we're going to see the calculation of goodwill in just a second, but we've already said it's the difference between purchase price and the net assets you've acquired. Again, can be capitalized, only purchase goodwill. We argue that the difference between what we pay for a company and the value of its balance sheet must be for everything that is not on the balance sheet, i.e. its relationships with customers, its relationships with suppliers, the strength of employees, etc. That is goodwill. Now, if you've purchased it, we can compute a dollar value for it. Whereas if we've internally generated goodwill, well, how do you know what the value of your employees, relationships with suppliers, relationships with customers actually is? So internally generated goodwill can't be capitalized. Purchased goodwill as a result of an acquisition can. Computer software development costs. Now this is a little bit of a tricky one as well. What we say here is any costs in establishing the software's feasibility must be expensed. Once feasibility is established, any additional costs can be capitalized. That leads us on to say, what is feasibility? Well, feasibility normally means that the software does what it's meant to do. So, what is expensed? Internally generated brand names. Too tricky to put a dollar value on them. Mastheads. These are kind of newspaper logos as well. Again, too difficult to put a name on them. As are publishing titles, customer lists, etc. Startup costs when you're setting up a business. Training costs, the cost of training your staff. Now you might put forward an argument that says, if I train my staff, they will generate higher revenues for me in the future, so surely I should capitalize this and then spread it. Problem is, you don't know with any degree of certainty whether training your staff does lead to higher future revenues, so we take a prudent approach and we expense. Any admin and general overheads, of course, get expensed through the income statement. Advertising and promotion, with the exception of that direct response advertising. Why advertising and promotion? Well, again, unless it's direct response advertising, it's very difficult to prove there's a link between the cost you incur and higher future revenues. So again, we take a prudent approach and we write it off. Relocation, reorganization, restructuring costs, again, going to be expensed, as are redundancy and termination. And then we get research and development. Now, pure research costs have to be expensed under both US GAAP and IFRS because it's uncertain whether it will ever lead to a profitable product. Product development costs have to be expensed under US GAAP, but may be capitalized under IFRS if it meets certain criteria. And those criteria are all linked to looking at whether it will lead to higher future revenues. So notice that little difference between US GAAP and IFRS there. Goodwill, we need to be a little bit aware of our goodwill calculation here. But again, we're not going to have to calculate in the exam. We just need to be aware of what it is. We won't really see goodwill properly until we do group accounting in the level 2 syllabus. So goodwill is simply going to be the difference between the price you pay to acquire a subsidiary and the fair market value of the acquired firm's net assets. In other words, what we do is we take the acquisition price, we then adjust their balance sheet, and we then bring in our percent of those net assets acquired. So if we acquired 100% of the equity, we'd bring in 100%. If we acquired 80, we'd bring in 80%. And the difference between the price you paid and the fair market value of the net assets you've acquired is goodwill. Now, be aware that these fair market value adjustments involve discretion of the management. Now, typically, we want to reduce the fair market value of net assets acquired to maximize goodwill. Why is that the case? Goodwill does not get amortized, so it has no knock-on effect in future income statements unless it is impaired. Whereas if you adjust assets and liabilities to their fair market value, they may have an impact on your future income statement. Imagine you acquire a subsidiary and you increase the value of its PP&E to fair market value. That will impact on future income statements via higher depreciation. So there's an incentive to minimize the fair market value of net assets to overstate goodwill because goodwill is not amortized. Goodwill analysis. Now, of course, the accountants would have us believe that goodwill is essentially what you're paying for all the things that aren't on the balance sheet. As we've said, the relationships with suppliers, the relationships with employees, the relationships with customers. Of course, if you take a more cynical analyst view, you might say that goodwill simply results from overpayment to acquire the entity. Now, if it's from overpayment, that's not going to lead to future earnings, and as a result, it isn't really an asset. So typically, the analyst will remove the impact of goodwill from ratios, take it out of the balance sheet, so remove goodwill from intangible assets. Now, if you're going to remove it from the balance sheet, you need to remove any impairment as well from the income statement. And then we should acquire business acquisitions, looking at the price we paid, the net assets we acquired, and the future earnings prospect of that division. Financial assets and liabilities. Let's have a little look at these. So these are equity that we hold in other companies, bonds that we hold in other companies, notes receivable, or not notes receivable, they're just short-term interest-bearing forms of accounts receivable, really. Notes payable are just short-term interest-bearing forms of debt, loans, and derivatives. So let's have a look at our financial assets and liabilities that are recorded at fair value in a company's accounts, i.e. market value. Trading securities are held at fair value. Available for sale securities are held at fair value. And we'll talk about those in more detail a little bit later. Derivatives are also going to be held at fair value if they're either standalone derivatives or they're used essentially for hedging purposes. Now, if you're going to record a derivative at fair value, it makes sense, if you're holding it for hedging purposes, that the asset or liability that you've hedged is also held at fair value, because the gains and losses on the derivative are meant to offset the gains and losses on the hedged asset or liability. Financial liabilities that are going to be recorded at fair value, again, are going to be derivatives, and also any non-derivative liability that is being hedged by a derivative. Again, same logic here. The liability's value, any gain or loss in the liability, is meant to be matched by a gain or loss in the derivative. Make a loss on the liability, make a gain on the derivative, and vice versa. So you record the derivative at fair value, you record the liability that's being hedged at fair value. Other assets, financial assets, are going to be held at either cost or amortized cost. Under US GAAP, unlisted instruments, so unlisted debt and equity instruments, are going to be held at cost. Held to maturity instruments are going to be held at amortized cost. Now, what is a held to maturity investment? A held to maturity investment is essentially a debt instrument where you have the intention and ability to hold it to maturity. And we're going to hold it at amortized cost. Cost, of course, is purchase price. What do we mean by amortization? We mean the amortization and any premium or discount when we purchased it. Now again, in terms of numbers, you're not going to need to worry about that on investments until level 2, although you will see amortization of premiums and discounts when we look at the issuance of bonds in a later reading. Loans, so bank loans, etc., are held at cost, and also our accounts receivable, of course, are held at the sales value that we made. Financial liabilities, well, pretty much all of our financial liabilities, bonds, notes payable, accounts and bonds that we've issued, amortized cost, and we'll look at the numbers on that a little later. Now, we are asked to talk about the classification of marketable securities. We'll see it in overview really at level 1, and then we'll drill down in some more detail at level 2. Now, marketable securities are classified according to 3 classifications that are based on the intent regards to eventual sale. We have held to maturity, available for sale securities, and then finally trading securities. Let's start with our held to maturity. By definition, it's a security that has a maturity date, so it's going to apply to debt rather than equity. And it has to be debt not only that has a maturity date, but you also have to have the ability and intention to hold it to maturity. Now, we're going to record these securities in our balance sheet at amortized cost. The income statement is going to record any income that we receive, which essentially is going to be a coupon plus or minus the amortization of the premiums, and any realized gains and losses on their disposal. Now, hang on a second. We should not be seeing realized gains and losses on the disposal of held to maturity securities because they should have been held to maturity. And if they're held to maturity, the balance sheet carrying value will be par. They redeem at par. There would be no gain or loss. Be aware there are penalties if you dispose of your held to maturity securities prior to their maturity dates. Available for sale securities, these are investments that may be sold for liquidity purposes. They can be debt securities, they can be equity, they can be current assets or non-current assets. Now, typically they're more likely to be current assets here. Now, the key point is we're going to hold them on the balance sheet at their fair value, i.e. their market value, their closing price on the exchange. The income statement, though, will be exactly the same as the held to maturity method. In other words, we'll only see the income, interest or dividends if it's equity, and any realized gains and losses on disposal. Now, that does lead to the question, where are these changes in market value, these unrealized gains and losses as fair value changes, going? And the answer is directly to stockholders' equity. Trading securities, these are securities that are held purely for their speculative purposes, so they are acquired for the purpose of selling in the near term. We're going to carry them on our balance sheet as current assets, and we're going to carry them at their fair value, i.e. market value. Now, what goes through the income statement? Dividends when we receive these, interest if it's debt, realized gains and losses on disposal, but also unrealized gains and losses. So these are the changes in fair value of securities that we've not disposed of. So the major difference between an available for sale and trading security is the unrealized gains and losses on investments that you still hold at year end. Under available for sale securities, they go direct into stockholders' equity, and you've seen them before. They're one of those comprehensive income statement items. Whereas on trading securities, they go direct to the income statement. So let's have a little look at an example just to see if this can clarify these points for you. So we've got Ellerslie Incorporated here that purchased a 35% annual pay $1,000 face value bonds at par value. The market price of the bonds at the 31st of December X4 had risen from par to $1,010. The interest on the bonds, well, we've got 30 bonds. They pay out 5% annual coupon, so 5% of par value. So the total interest we receive is $1,500. Notice we're keeping this example simple here. We bought the bond at par, so there is no premium or discount to amortize with these. So what are the balance sheet and income statement entries for X4 if they're classified as held to maturity, available for sale, or trading? Well, let's have a look. Under all 3 methods, the interest received will be the same. The interest received will go through the income statement, and it will be the $1,500, the coupon we receive. Now again, just be a little bit aware, but don't worry about it, that if the bonds were purchased at a premium, it would be coupon minus the amortization of a premium as your interest. If the bonds were purchased at a discount, it would be coupon plus the amortization of a discount. Again, not really going to be tested on that at level 1, but just be aware the interest received will be the same under all three methods. Now, what about these unrealized gains and losses? Now, we bought them at par, but at the end of the first year, they were sitting there at $1,010. So they've got a $10 piece of appreciation, 30 bonds, so we've got a total $300 unrealized gain. Now, if they're trading securities, of course, we'll record each of the bonds in the balance sheet at $1,010, and we'll take the unrealized gain of $10 per bond, i.e. $300 in total, and it will go through our income statement. So in the balance sheet, we've got the fair value of the bond. The change in fair value over the period is taken directly into the income statement. It increases net income, and therefore it increases stockholders' equity via retained earnings. What about our available for sale securities? Now, an available for sale security, as we said, in the balance sheet, in assets, it's going to be rather like a trading security. In other words, it's going to be recorded at its fair value. However, the change in fair value does not go through to the income statement. Instead, it's directly taken into stockholders' equity. Okay, in other words, the $300 unrealized gain is going to go directly into comprehensive income within our stockholders' equity. It does not go via the income statement. Finally, are held to maturity securities. Remember, changes in market value are irrelevant. These securities are going to be held at their amortized cost. And given we bought these at par, their amortized cost is just the original cost, i.e. the par value. Changes in market value are not reflected in the balance sheet. There are no unrealized gains and losses to put in either in net income or in stockholders' equity. So unrealized gains and losses do not affect the assets, equity, or the income statement. Okay. No, you can't have equity as held to maturity. By definition, equity is perpetual. It has no maturity date. So it only applies to debt instruments when you have both the express intention and ability to hold through to maturity. So let's have a little look at a kind of summary, really, that just brings this all together. So notice dividends and realized gains. Now, a realized gain is when you physically dispose of an asset. They always go through the income statement. Now, of course, we should also say interest as well. If it's a debt instrument, always goes through the income statement. Unrealized gains and losses will only go into the income statement for trading securities. Unrealized gains and losses go into the balance sheet for trading and available for sale securities. In other words, that third bullet point is saying we record the asset at its fair value, at its market value. Now, the unrealized gain or loss on available for sale securities doesn't go via the income statement. Instead, we take it directly to stockholders' equity within comprehensive income. Let's have a look at our current liabilities. So these are liabilities that meet any of the four criteria, so not all of them, it's just any of these. Expected to be settled in the entity's normal operating cycle. Remember that operating cycle is the time taken between receiving raw materials and selling finished goods. So it's the days of inventory on hand plus the days of sales outstanding, and we'll look at those when we calculate ratios later. So it's either they're expected to be settled in the normal operating cycle or held for the purpose of being traded, or really this is the one I tend to think of as the most common. These are liabilities that are falling due for settlement inside 12 months of the balance sheet date. So liabilities that are falling due within 12 months. And of course we can't have the right to defer payment for more than 12 months. If they don't meet any of these four criteria, then by definition, they're going to be non-current liabilities, or if you like, liabilities falling due after more than 12 months. So what classic current liabilities are we likely to see? Accounts payable, trade payables. Remember, these are essentially when we've bought goods or services from our suppliers but not paid for them at year end. Notes payable, which are just short-term interest-bearing borrowings. The current portion of long-term debt. So, for example, maybe you had a bond that you had issued with 10-year maturity. 9 years have passed, so it moves out of long-term liabilities and gets moved into current liabilities. Or if we've got lent due after more than 1 year, we'll go into long-term liabilities. We'll see accrued liabilities. Remember, this is where we've actually used a good or service and not yet received the invoice or paid for it. Taxes payable, the amounts that we owe the tax authorities based on this year's profits. And then finally, unearned revenue, and we've talked about this one already. Remember, our unearned revenue is where your customer has paid you, but you've not yet met the earnings criteria to record a sale. Right, a new LOS at last. Describe the components of equity. So our components of equity tend to be described as capital contributed by owners. And we split this into the issued shares, so the number of shares that have been issued, and we show them at par value and additional paid-in capital. Now, what is par value? Par value is the notional value of a share. So imagine a company issues a share with a par value of $1, and they issue it for $1.50. Obviously, cash goes up by $1.50, so stockholders' equity has to go up by $1.50. $1 would go into common stock. The additional 50 cents would go into something called additional paid-in capital. Now, additional paid-in capital is often also referred to as the share premium account. Preferred stock will go within equity as long as it is irredeemable. If it's redeemable preferred stock, then we tend to argue it's more like debt and we treat it as a debt instrument. Redeemable preferred stock has no votes, fixed dividends, just like a bond has fixed coupons, and a fixed life. In other words, redeemable preferred stock is debt under just a different name. So legally it's equity, but it has all the characteristics of debt, and as a result the accountants will treat it as a debt instrument. But if it's irredeemable preferred stock, we will see it within our stockholders' equity. Treasury stock, which is a negative balance reducing your stockholders' equity, is where the company has bought back shares in itself. And this treasury stock, when it buys back shares in itself, it can hold it as a negative balance, reducing stockholders' equity, and then reissue those shares at a later date. You should be aware that whilst they're holding treasury stock, those shares lose both their voting rights and their dividend rights. Yeah, can you imagine them not losing their voting rights? So the company can vote in its own stockholders' meetings. Be bizarre, wouldn't it? Retained earnings. Now remember, this is the linkage between the income statement and the balance sheet. Each year in the income statement, we compute net income. We distribute some to our shareholders by way of a dividend. Anything that is not distributed gets transferred into retained earnings in the balance sheet. So retained earnings is just a cumulative balance of the amounts that have not been distributed to your shareholders. Now, if you're looking at group accounts and you have subsidiaries where you don't own 100% of their share capital, then we'll also see non-controlling, otherwise known as minority interests. Why do we get these? Well, we'll see it more at level 2. But when you have, let's imagine we've got 80% of the share capital of a subsidiary. When we bring in their assets and liabilities into our group accounts, we bring in 100% of those balances. It's because consolidation is based on what you can control rather than what you own. What that means is we're bringing in net assets that don't belong to us, so the minority interest therefore reflects the net assets that we included in our assets and liabilities that don't belong to us, that belong to the minority, i.e. the 20% in our example. Then, of course, you're going to see your accumulated other comprehensive income items, the unrealized gains and losses on available for sale securities that we've just described, but also pension adjustments, cumulative translation adjustment on foreign exchange gains and losses, and also unrealized gains and losses on derivatives held for hedging purposes. So know what goes into comprehensive income, but the only one that you need to really understand the mechanics behind are the available for sale. The pension adjustments, the cumulative translation adjustment on converting an overseas subsidiary to your reporting currency, and to an extent the unrealized gains and losses on derivatives will all be level 2 subjects. Our LOS here asks us to analyze the statement of changes in stockholders' equity. Now remember, this is simply a reconciliation. It's taking stockholders' equity this year and reconciling it to stockholders' equity at the start of the year. So notice, all we're going to do is break it down into various areas, and we've got a column for the common stock, we've got a column here for retained earnings, and we've got a column. So total stockholders' equity at the start of the year was $75,492, but at the end of the year it had grown to, no it hadn't, it reduced to $75,128. Now, let's take the first column, common stock. You can see we're showing the issuance of shares. So we raised $1,282 from the issuance of shares, but we've also repurchased shares, paying $6,200. We've also got then our retained earnings. Now the change in retained earnings, of course, is this year's net income minus this year's dividend paid. So you can see we're taking beginning retained earnings of $26,664, adding on this year's net income from the income statement, subtracting this year's dividend to get closing retained earnings of $31,298. Then the next column is the weird unrealized gains and losses. So you can see we've got the beginning balances, which is just their total last year, and we've then got the changes. And remember, these changes are what go into our comprehensive income statement. So we've got unrealized gains and losses, in this case losses because it's a negative balance on our available for sale securities of 40. Unrealized losses on cash flow hedges. Cash flow hedges are just where you're hedging an asset or liability of 56. Well, actually, cash flow, that's not strictly 2, actually. An unrealized loss on a cash flow hedge is when you're hedging a future purchase or a future sale. Minimum pension liability, but it's a little bit out of date, that phrase. It's more likely to be an adjustment to funded status under US GAAP now. We've got that in there of 26. And then we've got a cumulative translation adjustment, and remember that's to do with converting your overseas subsidiaries back to your reporting currency using something called the all-current method. Remember, understand the mechanics behind the available for sale. You don't need to know the mechanics behind the others. You just need to know their names, really, and that they're included because they're all in the level 2 syllabus. Our next LOS says convert and interpret a common size balance sheet. So we need to take our balance sheet, which is in absolute dollar terms, and convert it into a common size balance sheet that is in relative terms, percentage terms. And of course, by doing that, it's going to facilitate comparisons over time because we can see the percentage of each asset and liability class changing, and it will allow us to compare between companies of differing sizes. So in the income statement, we looked at each income statement as a percentage of sales. In the balance sheet, we're going to look at each balance sheet item as a percentage of total assets. So in other words, you'd look at your ending inventory and your current assets and divide it by total assets to show it as a percentage. Now we're also asked as our last learning outcome to calculate and interpret both liquidity and solvency ratios. Now I'm not actually going to go through these ratios with you because they are covered completely in detail in a future reading. So we'll see liquidity ratios and solvency ratios later on. Your liquidity ratios are all about paying off your current liabilities. Your solvency ratios are all about the capital structure, i.e. debt to equity. So look at those solvency ratios: debt to equity, total debt ratio, financial leverage. We will explain and define all of those in a later reading.